I really doubt that we're going to see an inflationary cycle.
Most economic analysts believe that it will have a temporary or transitory impact.
The faster than expected increase in some of those prices is actually a good sign.
The overwhelming consensus is going to pop up a little bit and then go back down. No one's talking about this great,
This is something that will settle down.
Transitory.
And the data shows that most of the price increases we've seen were expected and are expected to be temporary. There's nobody suggesting there's unchecked inflation on the way. It's highly unlikely that it's going to be long-term inflation that's going to get out of hand. I don't know anybody who's worried about inflation.
Over the last couple of months, we actually saw it trended downward.
President Biden's chief of staff, Ron Klain, enthusiastically retweeted an economist who had said in part most of the economic problems we're facing, inflation, supply chains, et cetera, are high-class problems.
What is the Granholm plan to increase oil production in America?
Oh my God, that is hilarious. Well, the number one thing that the president can do is help get COVID under control. That we know is the root cause of inflation.
President Biden this afternoon saying he thinks we're at the peak of the crisis right now and that lower prices are on the way.
The inflation has everything to do with the supply chain. Make no mistake, inflation is largely the fault of Putin. I'm going to do everything I can to minimize Putin's price hike here at home.
If you want to get rid of inflation, the only way to do it is to undo a lot of the Trump tax cuts.
I think ever since you've come into office, things are really looking up. You know, gas is up, rent is up, food is up, everything.
You ready, folks? I'm ready. Welcome. This is what's going on. Long story short, the Federal Reserve absolutely squandered the interest rate cut yesterday. It was a wasted rate cut, and it indicates really bad things for the economy. They cut 0.5%, but interest yields have climbed, making borrowing more expensive, and unemployment remains low, according to the data, and stocks are at all-time highs. So this move greatly heightens the risk of inflation ticking much higher in the near future, very near future, which leads us to a cycle of hyperinflation in the coming months and years. Check this out. You know what? I'm going to save this one here. The signal that we're seeing here, you guys can see in this game of trades chart, the gray bars are a recession. And the pink lines here signal a massive yield curve inversion, which we're seeing right now is much, much greater than it has been ever since 1979. This signal has literally flashed only 4 times since 1962. Today, right now, I should say, is number 5. And it's the worst it's been since 1979. Let me get this chat box up for you guys. Just for some reason, it's not showing up. But let me move it to the top for you real quick. There you go. These are the expectations of a Fed rate cut. And it shows what the market expects the Fed is going to do with interest rates over the following year. This has fallen to a level that has not been seen since 1962. 1962. We're looking at 60 years that we haven't seen this sort of rate cut expectations. And we're supposed to believe that the economy and the American consumer is strong and resilient. The stock market is expecting the Fed to cut rates by over 1% over the next 12 months. And this has never happened before. We've literally not ever seen this in the yield curve or in rate cut expectations, ever. So the closest we've come to this in the past here, check this out. Here's the 1 year over the 3-month U.S. Treasury yield curve. The closest that we've ever come to this was when the market was predicting a 0.3% cut, which has only occurred 4 times since 1962. And now we're looking at rate cuts expected to be 350% larger than this 0.3% cut. Ricardo says, I'll be taking Dr. Metzler's advice and use my money wisely to fight hyperinflation. If you guys haven't seen the video that I did with PhD economist and former Fitch Ratings director, Dr. Marco Metzler, you should check that out. I just posted that video a couple days ago, because it will tell you exactly what a great way to invest would be during uncertain times, during recessions, during hyperinflation. And that information, of course, came directly from Dr. Marco Metzler, not from myself. In each of these 4 instances that we've seen this happen, you can see from the yield curve and then the gray bars that indicate the recession, the red line indicating the S&P 500. Each of these 4 instances that we've seen it so far, now being the 5th, the U.S. entered a recession shortly after, and the stock market dropped sharply. But this always happens after the Federal Reserve pivots and reduces interest rates. I appreciate it. Do me a favor, you guys, smash the like button if you're learning something, to share it with other people. These are the expectations of the Federal Reserve rates in the next 12 months and the federal funds rate, along with the 1 year, over 3 month yield curve overlaid as well. The gray bars are recessions. The red line is the federal funds rate. You can see the recession is always called after the pivot every single time. It's only happened 4 times, and this is the 5th time that we're currently seeing it. Historically speaking, the Fed cuts rates when the economy is weakening, and they're always behind the curve. That's exactly what happened in these last 4 signals that we're currently seeing on the screen now. Here it is. Basically, here it is in white, if you want it to be much more clear and much more clearly indicated. The red bar, the pivot, the effective federal funds rate, reducing the interest rates, the recession in the gray lines back in the late 80s, the 2000 dot-com bubble, the 08 GFC. 2019, for those of you that are unaware, was a massive crisis, a crisis of the Federal Reserve's repo operations market. It was literally exploding, and the Federal Reserve had to step in and take over the repo operations from the banks in order to prevent a market collapse. This happened immediately before the, well, let's call it the cerveza sickness, right? That happened in 2020. Some people like to say that we had to print insane amounts of money in order to bail out the country because of that cerveza sickness. The reality of the matter is that the bond market was imploding, and the only way to bail it out was to print trillions and trillions of dollars. That leads us to inflation. Look at what we're seeing now. We've already seen the Fed pivot, and they came out strong with a 50 basis point pivot. That will literally reinflate. I shouldn't even use reinflate. I shouldn't use that word twice, but it will reaccelerate inflation to a massive degree. A massive degree. And I know right now a lot of people don't see it coming, don't believe it to be the case, but I assure you, my friends, that is absolutely the case, and that's absolutely what's coming. Again here, when you raise that threshold from the current amount of 1% rate cut, which has not been seen ever since these have been being tracked in the 1962. But when you raise the threshold to 0.2%, there are two more data points, and that includes 1989 and 2019. As I just told you guys, the market collapsed in 1989. The market was expecting Fed rate cuts. In 2019, prior to the collapse of the the standard repo market. Those are two different things, just for clarity. But those two cases were different from the signals that we saw in the past by over 6 months. Let me go back to that chart. Stocks continued to rise in those two cases in 1989 and in 2019 until the recession eventually hit. And when that recession eventually hit, then the market followed. Check this out right here. Again, the yield curve and the S&P 500, as I showed you guys, 1989 with the red bar. And then, of course, the stock market months later, after it continued to hit new all-time highs in 2019. Months later when it continued to hit new all-time highs. So what I'm feeling right now is that we are not looking at a repeat of 2008. We're looking at a much bigger problem, a compounded problem. One that is going to continue to be exacerbated by the cutting of rates, the printing of money, the fudging of the economic data, and the inflationary data. New all-time highs are highly likely before a recession actually occurs. And I'm not talking about for a few days or a few weeks. I'm talking about for an extended period of time. For several months, it's likely that we will see new all-time highs before a market correction actually occurs. So I will be playing that as well in the markets without question. Economic activity continues to weaken, and it's proven from the United States ISM manufacturing PMI. This is a massive, critical warning sign to the greater United States economy. And this decline in this is reflected in key indicators, such as the ISM manufacturing PMI that you're seeing on the screen now. It's recently taken a pretty big downturn. And it's a widely watched survey, and it measures business conditions in the manufacturing sector. It tracks things like production, new orders, inventories, and employment. Let me see. Maybe I got to scroll down for you guys a little bit. Yep, make this screen just a little bit larger. There you go. Now you guys can see what I see. Ricardo says, also by the unwinding of the Japanese yen carry trade. Absolutely right, my man. The Japanese yen carry trade is going on strong. Going on strong. And contrary to popular belief, a lot of people on Twitter are saying that the United States reducing interest rates will negatively affect the carry trade and cause a downturn in the Japanese markets and, as a byproduct, the American markets. After my I had previously thought so as well, but after my discussion with Dr. Marco Metzler, again, PhD economist, former Fitch Ratings director, the man is incredibly intelligent, and he's seen this in the past. He believes that the decrease in the interest rates in the United States will not have the same effect as the increase of their interest rate in Japan. I agree with him after looking at the data and having a discussion with him. The arbitrage will not be destroyed by the United States reducing interest rates. Japan owns so many U.S. government bonds here, both of our country and of their own, that the arbitrage can continue in other countries outside of the U.S. markets, even if the Fed cuts rates here in the U.S. It's until Japan cuts interest rates, will the Japanese yen carry trade, gray swan if you call it, I won't call it a black swan, gray swan, continues to have problems in these markets. Now, looking at the ISM PMI, when it's high, which is typically above 50, which we saw here in March of 2024, it signals that there's strong economic growth. And it suggests that factories are producing more, new orders are increasing, and employment is rising. So a high PMI is indicative of an expanding economy. But the current state of the PMI tells a vastly different story. And even a few points makes a huge, huge difference. Things are contracting in our economy. And it's happening faster than expected. Hence why the Federal Reserve thought it a good idea to lower by 50 basis points. The lower the PMI, below 50, signals a slowdown in the manufacturing sector. That means businesses are cutting back on production, cutting back on new orders, and all of this is a precursor to the broader economic downturn, right? We saw Jerome Powell call it a recession, and he immediately apologized for it and changed the word to downturn. I should pull that video up for you guys. But the recent drop that we're seeing in the ISM manufacturing data, it's not a small hiccup. It's a sign of a real deep underlying issue within the United States economy. And this contraction will persist, and the likelihood of the United States entering a recession becomes even higher. So a lot of people believe we're already in a recession as they look at the reality of what's going on in the world around them instead of the fudged and obstructed data, the obfuscated data from the Congressional Budgetary Office and the Office of the Comptroller of the Currency and the Bureau of Labor Statistics. That's why they call CPI the CP lie. So the economy right now still has time to correct course, but that will only happen with a ridiculous amount of money printing that will further inflate the bubble that we're currently in. And the recent spike that we saw in the 10-year Treasury yield, the 10-year Treasury yield has just reached 3.75%. This is a part of a larger trend that we have seen since the beginning of 2023. And over the past 2 days, yesterday and today, since the Federal Reserve cut interest rates, the yield jumped by 15 basis points, guys. Right, Bernard. Jerome Powell literally ended the press conference immediately after he said the R word, the recession word. I'm going to show that to you guys right now because it's so funny that I have to take a quick, it's a 30-second clip that I have to show you guys. Here it is.
Vulnerable to a shock now that could tip it into recession.
I don't think so. I don't, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No. Thank you.
Thank you.
Does this data indicate growth? Absolutely not. He's gaslighting everybody. Jerome Powell's gaslighting everybody. He's stammering. He's stepping over his own 2 feet trying to say this. And he even uses the word recession, knowing that he shouldn't be using the word recession, as it triggers high-frequency trading algorithms and quant algorithms to basically bring the stock market down automatically.
To a shock now that could tip it into recession.
I don't think so. I don't, there's, as I look.
I don't, there's, come on now.
Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn.
The data that we're looking at right now literally shows that there's an increased likelihood of a recession. Growth, reduced growth. Here's the 10-year yield for you guys. Again, it's literally went up 15 basis points as the Federal Reserve cut rates by 50 basis points. This makes borrowing harder and more expensive for the average American. Cutting rates did not make mortgage and auto loan prices come down. Cutting rates increased mortgage rates. Mortgage rates and auto loan rates are higher today than they were the day before yesterday, before the Federal Reserve cut rates. I'll say that one more time. Mortgage and auto loan rates, interest rates, are higher today than they were before the Federal Reserve cut rates by 50 basis points yesterday. This is directly due to the fact that there is an understanding that our economy is in bad shape. And this echoes a historical pattern that I showed you guys earlier from 2008, when bond yields similarly rose after a 50 basis point rate cut by the Federal Reserve. So there are underpinnings of similarities to 2008, 2000, 1979, and even the two underlying issues that were kind of opposites, that were 1989 and 2019, that showed that the stock market continued for several months to get to new all-time highs before the recession occurred and before the decline in the S&P 500, the correction in the S&P 500 actually occurred. Because we are in the largest bubble in asset classes we've ever seen in this country. So currently there are several factors that are driving these bond yields higher, despite the rate cuts that already happened and the anticipation of rate cuts of another 1% over the next 12 months, which has never happened in the history of the United States. Never. Not to mention falling inflation, right? The CPI. First, the United States economy remains unexpectedly resilient, which has caused markets to push out recession expectations and hold off on pricing in these rate cuts. They're not pricing in these rate cuts. This contributes to the rise in these bond yields, guys. And it's because investors believe that rates will remain elevated for longer, right? Higher for longer is legitimate. Look at this article from Market Insider in 2023. They said inflation is falling and the end of rate hikes is in sight. So why are bond yields still rising? This proves the point that there's multiple critical factors here that are due to the surge in the United States Treasury bond supply, partly due to the Fed's tightening that has occurred, which reduced their holding of treasuries, forcing the government to sell more to the public. And the United States issuance of bonds right now is at all-time highs. This, of course, drives bond prices down, returns on the bond down. So investing in bonds is a bad idea. And it returns the yields up, because as yields in bonds go higher, the return on the bonds goes lower. And speaking of the Bank of Japan yen carry trade, their policy shift by the Bank of Japan towards loosening control of their own government bond yields attracted domestic investors away from United States treasuries into investing in Japan and not in the United States. This has a further influence in the rise of United States bond yields and a decrease in the efficacy of investing in American bonds. Long story short, guys, experts here are predicting that yields will stay elevated for a significant period of time. Even if rates are cut, even if rates are cut more, yields will stay elevated. Again, look at the chart. There has never been the market's expecting a 1% rate cut ever over a 12-month period. So this has potential to easily reach a yield, a percentage of around 4.5% for the 10-year bonds. In the near term, I mean, in the very near term, in the short term. And this could happen before gradually declining as the economic data comes in much worse. And as you guys can see, in 2020, they were looking at 0.3%. In 2000, they were looking at 0.6%. In 1980, they were expecting 0.7% rate cuts in 1 year. 1974, about 0.5%. Right now, 1% is massive. And they're not doing this because they don't think that a downturn is going to happen. They do this because the Federal Reserve expects a recession in the coming months.
Vulnerable to a shock now that could tip it into recession.
I don't think so. I don't, there's, as I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. It's so I don't really see that. No, thank you.
End of meeting. That's it. Final question. We're done. I accidentally said recession. I stammered and stepped all over my words for the entire second half of the FOMC meeting. And the S&P 500 will continue to reach new all-time highs until the economic data is actually properly released. Because until that happens, we will continue this farce, this fallacy, that the economy is strong, that the economy is resilient, that CPI is down. We will print more money until inflation is no longer able to be hidden, until we have to recalculate and redefine the weighting of the CPI calculations once more, and it starts to take off on us once again. This is exactly why Dr. Marco Metzler told you guys in the video that we did a couple of days ago, the day before the FOMC, that we're leading into a period of hyperinflation. This isn't because I want to say this. I don't enjoy saying this information because it negatively affects my family and friends and all of you guys here listening and watching. But it's important that you remain educated in the matter. And the fact of the matter is that there's a lot better investments out there than bonds. There's a lot safer investments out there than the SPY ETF. Let's put it that way. If you guys want to look into alternatives, check out that video I did with Dr. Metzler. Take a look into private equity. Take a look at XCHANGE. We are creating a new stock and crypto brokerage that you can actually own. You will receive a lot of benefits and perks that are unheard of, that no other stock and crypto brokerage has ever done before. None, ever, in the history of the world. Why? Because they want to sell themselves to hedge funds. We want to let retail investors own the company because that's the entire point of the company, to benefit the 99%. I appreciate you, Irishman, Al Capone, Game Hub. Everybody, thank you very much for coming. Let's do another one of these. I'm going to have a different topic for tomorrow. And then on Saturday, I'll be meeting with my guy, Aaron, and we'll be doing another podcast on the Cash and Capital podcast on YouTube and Rumble. That will be premiering on YouTube next week. Make sure I'll drop a link here for you guys to check that out. I wish you peace and wealth. Make sure you're properly hedged.